What up, though, players and playettes? So basically, what just happened was what I expected, which a lot of people expected. Jerome Powell just raised interest rates a half of a percentage. And it's the first time it went a half a percentage in probably the last like 4 meetings. So before that, it was 75%. So say Fed raised interest rates half a point to the highest level in 15 years. So this looks bad, but technically it's not because he's finally starting to lower everything down. The Federal Open Market Committee voted to boost overnight borrowing rates a half percentage, taking its target range between 4.25 and 4.5. Now, the way the market reacted was initially a big drop. Soon as he announced it, we had a big old drop. Didn't like it. Reason everybody didn't like it is it's just the way on this date, it's either things going to shoot up like crazy and rally, or it's going to completely shoot down. Depending on what you like, no telling, because if it would have went up to right here, it would have calmed down, then would have shot back down lower to about right there. And, that's how it would have did. Or, like today, it shot down, went over to the side, and the reason we got this big drop is people like, okay, we understand what you're talking about, but what about moving forward? What's going to happen in 2023? And he completely went back to the old Jerome Powell where he didn't answer shit. Clearly, he just basically said, I don't know. We're going to raise interest rates. We're going to keep on raising it, but we want that 4% to now be about 3%. And lady asked him, how are we going to get it there? And he basically said, I don't know. While it's simple math, because say if you want it to be 4.5, and if you're going to have these meetings and raise the interest rates every time, you can do the math and be like, look, the highest we got multiple ways. We can't raise it 75 basic points no more than 2 times. It got to be 25.5. You can do the math and give a clear answer. Since he didn't do that, the market was like, oh, hell no. Nah. And it dropped down right there. Once we get right here, the emotions finally come out of it, especially after 4 p.m. Once the market is closed, the emotions is finally going to come out of everything. It's going to be like, okay, all right. What fundamentally changed and happened today? Nothing. We knew everything we knew what was going to happen happened today. Everything. The only thing we didn't know was the future. Would nobody know the future? So that's everybody wanted to know what was going to happen in 2023. He basically said, I'm just going to keep on raising it. So once you do that, the market like, all right, shit. If I'm broke, you can't pay your rent. Once you broke and can't pay your rent, you down here. You broke. All you can do is make some money and start trying to figure it out. And they figuring it out. And you see us rising back up. And we're going to trade sideways and probably rise back up and probably end the day right about right there. And we're probably in the day only down 150 points on the Dow, which is technically not bad. I was expecting a bigger rally today, but I didn't know the emotions of him saying he don't know about 2023 was going to play into that much of a factor with it. But besides that, we will see how everything end up going. Here's what another rate hike from Federal Reserve mean to you. Yeah, unfortunately, it sucks. It just means your money ain't about to go as long. Let's look at it, what it mean to you. Why smaller rate hikes may be pretty good news. Yes, we need that. U.S. central banks will most likely approve 0.5 hike. Well, this will push the benchmark to that rate. We already know that. And finance just adults, millionaire. What does this mean to you, for you? Another interest in the prime rate will send financing costs even higher for many other forms of consumer debts. On the flip side, higher interest rates, which means savers will earn more money on their deposits. Yay! Now when you put money in your bank, you're going to earn an extra $3, if that. Credit card rates are at a record high and still increasing, said this person. Auto loan rates are at an 11-year high. Home equity credit lines at a 15-year high. Online savings accounts and CDs yields haven't been this high since 2008. So we look at the mortgage, 15 to 20 year or 15 to 30 year mortgage. The average 30-year fixed rate mortgage currently sits at 6.33, down from the mid-Novembers when it was at 7%. So it calmed down a little bit. So hopefully 7, it shouldn't go higher than basically 7. For buyers, 30-year fixed rate, this basically when people that don't understand the rates, right? Your loan, if you got a $300,000 house, you'll be paying $1,200 a month with 3.11 rate. But today, if you did it versus when things was down, you're going to pay an extra $580 a month. That is another $208,000 over the lifetime of a loan. So that's why we want these numbers to be as low as possible. If not, it's going to be bad. Credit card annual percentage rates are now more than 19% on average, up from 16.3% at the beginning of the year. So credit cards are going to cost you a little bit more. Even though auto loans are fixed, payments are getting bigger because the price of the cars is rising along with the interest rates on the new loans. So planning to buy a car, you should wait for the month. You should basically wait and don't do it, or just cash out on a car. So you're going to be paying a little bit extra, more money. It's not as much. Student loans is the same thing. Interest rates on a federal student loans taken out for 2023 academic year rose close to 5%, up 3% over the last year. It won't budge until next summer, so you stuck right there. Savings accounts, here go to good stuff. Savings accounts are currently at 0.24% on average, thanks in part lower overhead expenses type of yielding. Online savings rates are as high as 4%, much higher than average. So if you do one of those with a balance of $1,000 to $25,000, the difference between the lowest and highest rate percentage yield can add additional $51 to $965 a year, and this much in 10 years according to this. So that's if you do a CD. If you got money, just sit and hold for 10 years. So that's basically what's going on. Make sure you guys hit that like button, hit that subscribe button. Overall, I believe the market will be okay. I wish he just kept it funky and just told us what we needed to hear. Just Jerome Powell, ladies and gentlemen, Jerome Powell. So it looked like we're trending back down a little bit. The Dow was flat, the markets. But we shall see. Lando says, hit the like button, hit the subscribe button, and I am out of here.